Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. Yes, you are not having a mirage, an illusion. Kilroy is right on the screen. I'm making the Kilroy video, finally. Those of you who are part of the club, you guys already know the whole thesis because I've broken down in the analysis, everything. You've had probably tons of hours of me explaining to you guys the thesis here. If you guys are wondering what the heck is he talking about, check in the description below. You can check out the embedded video in that link. It explains it all, as well as you can have just a free trial if you want to check it out. If you don't like it, you don't like it. But here on YouTube, I'm going to be explaining the Kilroy thesis. It's already recovered a decent chunk. We're up on the position. We're up on all our REITs, actually. And I'm going to be going through why did I choose Kilroy when I did. Okay, and I think Kilroy got a decent amount of attention from some retail investors out there who were buying it at unfavorable prices. So I'll repeat to you guys my overall idea behind REITs. So if you recall, and if you've been following the channel for quite some time, you can recall that in 2022, January in 2022, I released a video on REITs explaining why I'm selling all my REITs. And at the time, the largest REIT holding I had, Realty Income and a couple others, I liquidated those in an effort to capture that idea that I believed REITs were going to be one of the entities that would suffer during the liquidity crunch. If you're wondering, liquidity crunch, trust me, that was like Capital Mindset theme 2022. I can't tell you how many videos, how many live streams I was going over the liquidity crunch phenomena. And I call it liquidity crunch because I think later on people start calling it like liquidity crisis, etc. But it was just a conceptual idea of discussing what's happening within the financial system, and certain asset classes would be harmed more than others. Real estate, I did a flip on it and said in 2023, I believe this was the accumulation year for REITs. And I stand by that. Now real estate, if you've been following the portfolio, has made up now about 10% of the overall portfolio. So I am now decently exposed to real estate. I do believe that 2023 was the accumulation year. Is it still the accumulation year? Yes, it's still continuing. There are still opportunities within REITs. However, they're not as good as they used to be. So there's some out there that are still hitting new lows. We'll have videos on that. I will make videos on more REITs. If you want more REIT videos, go ahead and subscribe. Comment down below, yes, more REIT videos. And then I will be releasing more REIT videos in the future. So let's talk about Kilroy Realty Corp. So Kilroy, for all intents and purposes, we're going to focus on its office aspects, even though it doesn't necessarily only do office. So you got to understand that. It does other things besides office. It's pretty diversified. And what we're going to be discussing, though, is the office component. So you have articles like this, oh, office is dead. I agree with this. It's dead for what it used to be. It's not going to recover to the same way. If you're a believer that office is transforming, well, this is a thesis you might be interested in because that's where I'm at. I believe that office is transforming. What do I mean by that? Well, we're going to have hybrid work, right? We're going to need less office space, but maybe higher quality office space. That word I just used, higher quality, that's very important. Let's put a pin in that. So let's come back to office space. So within real estate in general, you have Class A, Class B, Class C properties. Simply put, you can go from higher quality to lower quality. And higher quality could mean newer property, better location, etc. And higher quality properties, they have a higher price per square foot. They can demand more for the same amount of space. B and C, they can't do as much. So Kilroy here focuses on Class A properties, okay? And we're going to talk about another REIT that also focuses on Class A that I offered in my analysis to the members as an alternative to Kilroy, and also I think did better than Kilroy. So I should have probably picked Kilroy. Pick the other one besides Kilroy, but I still think Kilroy has some more upside, and I'll explain why. But it's not guaranteed upside. It could be that that's the reason why the other one performs better. So going back to the reasons or the types of properties, Class A properties during a downturn are typically more stable than non-Class A properties, so Class B and Class C. So Class A properties, when let's say you have a 50,000 square foot office and you're like, hey, we only need 10,000 square feet. Well, you don't want to pay 50,000 at the Class A. That's why you were in the Class B property. So you're not willing to pay that price per square foot. But now that you reduced it to 10,000, well, why not try to go for the nicer office space in the better location? Maybe it's more convenient. Maybe it's a safer location. It has more amenities. It's just a nicer space. Why not go for that? And that's exactly what happens, right? So a Class A property is going to have an easier time filling in with tenants. Even when they lower the rent, which is unfortunate for them, even when they lower the rent, it's still going to be always more attractive than the Class B and the Class C. So if the Class A property lowers the rent to equal, let's say, the Class B property, the Class B property cannot stay at that rent. In order to be competitive, it's going to have to lower its rent even more because the Class A property is going to dominate and just take all those tenants, because why would you pay that amount there? Why not just pay, if you're willing, if that's what your budget is and you're willing to pay that, go for the nicer property. So you're going to see that. And typically what I'm trying to focus on, the theme there is resilience. Class A, resilience. And so I know I could have probably picked a Class B or Class C property, REIT, that could have probably yielded better returns, but that's a lot more risk. And so I decided to just go with Class A. Now, the other REIT that I was referring to is Boston Properties, ticker symbol BXP. BXP has actually performed better, okay, than Kilroy from the lows. It's up about 43%, while Kilroy is about 38%. Now, I believe Kilroy had a slightly higher yield at the lows. Boston Properties also had a very nice yield. So if you secured those yields, congratulations. I don't know if you'll ever see this again for office REITs. I really don't know. So if you didn't know that this was happening, I'm going to introduce you to the Armageddon of office REITs. You just lived through it. You probably didn't know it even happened. And if you were watching it and you were too scared to invest, don't worry. I'm not going to blame you for that. I'm not going to say, you're a terrible investor or anything of the sort. It was very scary. All the information, all the news, all of it was terrible for office REITs, right? It's still pretty bad. These are not recovered companies. Okay, there's still a lot of pessimism. It's just we're kind of seeing it play out in the favor of the highest quality ones. Okay, but still they're not out of the woodwork just yet. So keep that in mind. Okay, so going back to the office companies right here, like Boston Properties and Kilroy, they got to valuations cheaper than 2008. Okay, during a recession. This was a huge point I kept harping on. During 2008, which was a real estate driven recession, they are cheaper than they were then. That's how bad 2022 was. You need to wrap your head around that. So 2022/2023, right? The accumulation year in 2023, that's how bad that period was. They were cheaper than 2008. Okay. Now, there's reasons, right? Because there is a huge change in trends regarding how office space is going to be used. There's time and time again, right? We're seeing like the bank crisis and then the office crisis, et cetera. All of these properties that they overbuilt. There's a ton of Class C, Class B properties that really shouldn't even be there. Honestly, they should be just converted to residential. So there's overbuilt markets, et cetera. You could argue, I mean, you can see what's happening in New York right now. The vacancy levels is pretty alarming. And again, but Class A is going to have the lowest vacancy levels. That's a rule of thumb. Class A is always going to have the lowest vacancy levels compared to Class B and Class C. All right, going back to the REITs though. So you had the opportunity in front of you to purchase REITs that were at their lowest valuation in, I believe, their entire history. There wasn't a lower valuation period than just now, okay? And REITs in general in 2023 hit a very low valuation point. Low leverage, historically high FFO multiples, or low FFO multiples, historically high FFO for each of these REITs. And again, focusing on that leverage component, it's historically low right now for all these REITs. So they have been levered up a lot more in the past than they are today. Now, going back to Kilroy, the champion that I chose, their reason for their extended discount to Boston Properties is geographical exposure. The reason why in my analysis to the members was, hey, you have Boston Properties here as an alternative, and you might actually like this one because it's a lot more diversified geographically. Boston Properties also focuses on the same strategy of Class A properties. So you're still capturing the idea that I just laid out of saying, well, the office isn't dead, it's just evolved, it's just changing. I'm gonna go with Boston Properties because I don't want that California concentration. I want that, that same idea, just more nationally and spread out. There you go. You had Boston Properties. And again, that performed better because perhaps the market also is more attracted to that idea versus something like a Kilroy. It's very much more concentrated. And Kilroy, again, has office, has life science, and also has some residential. So also diversified in product type or property mix, but they're still kind of classified as office. So I'll go over also the slide deck from Kilroy. So this is a slide deck from June 2023. This is their at a glance. They no longer trade at an 8% yield. They were actually even higher for a time period. They were higher. I accumulated a decent amount of shares. So I'll talk real quick with what I did with this. So within the club, I have the holding company portfolio that also follows a very similar strategy to the personal holdings as well. But what I did, I used to have some Kilroy in it. And then what I did when it dropped decently is I sold the shares of Kilroy in that entity, and then I repurchased it in my Roth IRA. And so I was able to kind of benefit on both worlds, and I got a really good price, kept my exposure to it, and still got some advantages from it, but on a separate entity. So they also have an investment grade balance sheet, which is also very attractive. Same with Boston Properties, just to let you know. So again, I'm picking basically the top tier companies. And I like the analogy of my investment style. If you've been following me for quite some time, you know that I like to kind of run into the burning building and try to find the room. If the analogy of this is like the rooms are all the stocks, the building is the sector, I like to run in there, find the rooms that are fireproof, and get into those rooms and then profit, let's say. That's ideally when we were discussing in the live stream, and Andrew made a point of this, so I just want to make this point as well. It's not simple at all. In fact, I'd say you shouldn't really do that. It almost makes it sound like you should just buy stocks that went down. Do not do that. You will lose tons of money because it does take a lot more work. I know that in hindsight, you look at me showing you guys these were the investments I did, and you're maybe new to the channel and you're saying, wow, okay, he did that investment, he did that investment, he did that investment. It's easy. You just buy stocks that are down. No, if you do that, you will lose your shirt because more often than not, there's a value trap. More often than not, they're down for good reason. It's very few and far between that a stock is down and it's down for no good reason, right? So Meta's, Netflix's, Unum's, Cardinal Health's, AbbVie's, those are not happening all the freaking time. They're happening, I'd say probably there's several that you can find in a year, but there's a lot of work that gets into that. So anyways, they do see, okay, improving return to office trends. This has been, we've been talking about this in the community for a long time. The trends are still in the favor of the Class A properties. There is a movement to return to office. I'm sorry if you're working from home, all you're proving, right, if you're doing your job efficiently, is that it's doable to be done anywhere, okay? And what that means is I can use labor arbitrage, or not labor arbitrage. I can find cheaper labor anywhere in the world, right? I just need someone with the talent, so I can pay someone in a much cheaper geography. That's all you're proving to me at the end of the day. Efficiency rates, though, for work has gone down, right? So that's the problem as well for companies that they have to fix. And a lot of them are wanting to return to office because those efficiency rates have dropped. I know that you yourself might be saying you're the exception, and you might be the exception. You might be working from home and you're just as efficient, but that's not true in aggregate, and your situation or your reality isn't the truth for everyone, okay? It's maybe for you it is, but not for everyone. And so companies deal in the averages, right? So if the average of their employee base is less efficient, that harms the company. It might be that you're that one guy that's amazing, or there's a couple guys that are amazing, but that doesn't mean that on the averages, it's not getting worse. And if it's getting worse on the averages, the company's going to underperform. So they have a strategy built for all environments, basically. I think that's referring to their life science, et cetera, all their different types of properties that they have. Outperformance in quality assets. So they believe, again, and I agree with them here, this is part of the thesis when I was originally buying their shares. It's focusing on that quality, it's going to perform well. And I know that there has been some retail investors in the YouTube space that have purchased Kilroy, but the problem with them is, it's not a problem with them specifically, but the problem is that they were buying it way too early, not understanding what was the risks going into this. And now what you were just presented was with a very good risk-adjusted rate of return when you're considering, again, all the risks, all the concerns that come with office. You were getting an extremely high yield for what has historically been a very strong operator, very strong capital allocator. Now, Kilroy does have, and we'll probably get to, they have a fortress balance sheet, by the way. Forgot to mention that. Fortress balance sheet, everyone. We'll get to why there's probably an extra discount. But yeah, recent return to office announcements. So this is what they're talking about. You probably have seen this in the news. And yes, it's happening because, again, efficiency rates are down. And then joined Meta in person and transferred remote to remain in person, performed better on average than people who joined remotely. This is what I'm talking about. They're just highlighting from what people are saying. So for those of you in the community that have exposure, investment exposure to Kilroy and BXP, and you're like, heck yes, we finally, like, you lived through it. You went through the community together, and we did the analysis, and we're showing to be correct in our analysis thus far. So congratulations. And so it's also, this video is also kind of a pat on the back now, because it got dark, guys. Like it got to a point where the prices were, $26. And I mean, heck, some of us, we were like, no, yeah, we are still right. Nothing has changed. This is just sentiment. That's the reason why it's down. Sentiment, not because of anything changing in the thesis. And that's important. So we are seeing improving occupancy rates. They've been talking about it. So it should be no secret. And it should be considering in the future quarters, it should be continuing in that direction. I want to find their part where they talk about it. A strategy built for all environments, pure office REIT average. What are you showing? So youngest portfolio. So this is kind of talking about the, they really just don't even, they don't even name them. They just do that. But yeah, Kilroy has the youngest portfolio. And again, part of being Class A is focusing on the youngest assets. So the younger the building, the higher the grade the building, because it needs less updates, et cetera. There's probably better design to the building, probably more efficient, nicer looking, et cetera, all that jazz. So now I don't really feel like this isn't too important to go over, but this is kind of their capital allocation cycle. And then, yeah, 92% lease. That's very high, actually, for the office space right now. 92 is not good for like triple net. Triple net, you want it really close to 100, like 97, 98. That's considered good, 99. But yeah, and then they have the development pipeline that, you can kind of pause there and look at that real quick. But it's just pretty good across the board there. Now here, what they want to talk about here is the top 10% buildings reduce their vacancy by 100 square foot, while the bottom 10% increase their vacancy by 250 square feet. So this is talking about what I was just discussing before we went on here, was when you see that reduction in the lower quality, that doesn't mean that the higher quality lose. No, the higher quality still can win, because maybe they reduce their square footage in the lower quality building, but with that reduced square footage, they want now a higher quality building. Okay, so again, the reduced their vacancy. So that means more people, more tenants. Okay, and then the bottom 10% increase their vacancy. You get what I'm saying there? So you might want to, if you didn't get that, rewatch it again, but reduced vacancy, reduced empty spots, and then the bottom 10% increased empty spots. Okay, but yeah, that's what they're kind of highlighting there. And so I want to get back down. Where did they put this? I guess they didn't put it. Yeah, the geography. I was looking for the geography. I guess they didn't want to put the geography because that's a negative right now. But what I was trying to find was the geography of Kilroy, and I think we can probably find it on the website. So if we go here, oh, there it is, properties. Okay, so what you see here is, look, Seattle, California, 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 Texas. Notice anything? Well, if you noticed, hey, that's a lot of California exposure. Exactly. That's why I think the discount is extra on Kilroy versus a Boston. Boston Properties is all over the country. Kilroy is California and Washington, and then some little bit of Texas, a little sprinkle of Texas in there. So right now, Texas is the hot market. Florida is the hot market. California's very pessimistic outlook. And so I still think that there's an additional discount because of that California exposure. That's why I chose Kilroy as well, on top of it being the youngest portfolio, which you saw of a weighted average of 11 years, and that California exposure. I'm saying, hey, California is not that bad. It has its problems, right? And I'm not a California fan. I lived in Florida, Texas. I've lived in like the two states that are antithetical to California, but I don't think it's that bad. I think it's bad, and I think California's golden days are behind it, right? but I don't think it's that bad. Okay, and so that's why I chose to invest in Kilroy versus Boston Properties. Although again, for the time being, it appears as Boston Properties has been the better investment. Okay, but in my analysis, I presented both as the same idea, same thesis. Okay, so all that to be said, what is the valuation for Kilroy? What am I doing with my Kilroy position? Well, Kilroy, if I'm being honest, I am not buying any more. I am, maybe I decide to reinvest the dividends here at this point. But I think on a total return basis, I'm gonna be very satisfied with what Kilroy is gonna provide to me in the portfolio. It's not the biggest position, but it's a good size position. I'm passionate about this thesis, right? Especially after the amount of pushback I received on it. So I love that when that happens, because it makes me look back and say, am I wrong? Because if I'm wrong, a lot of people are telling me I'm wrong. So there has to be a lot of evidence against me. So I really should investigate and see why people think I'm wrong. And then if I come out the other side and say, I'm not wrong, well, there's two options. I could be extremely arrogant or I did more research and I figured out, okay, the sentiment is wrong from the general public, from the general investing base. For the time being, it appears as though that is the case. But we are still not out of the woodwork yet. So I would say that it would probably be taken, this is my softball projection, 2024 is going to be the year where we're going to see perhaps a lot of these REITs appreciate. And the reason why, and I've talked about this in the REIT video back in 2022, why when I was selling them, REITs, real estate, is very slow moving, slow to change, right? So you look at the recapitalization of office space, hasn't really happened. Recapitalization just means, revaluing mark to market, hasn't really happened. And in private real estate, it's a very slow moving machine. With REITs, because it's publicly traded, a lot of the information gets advanced much quicker, right? So the reaction is very quick, very fast. So that being said, Kilroy and these other REITs, they reacted faster or in advance to the physical real estate market. So I think they've priced in a lot of negativity. So 2024, the positivity might be at 2025, but the REIT market isn't going to wait till 2025 to illustrate or show that positivity. It's going to react in advance to that. So that is why, while real estate REITs looked really negative, you were seeing private real estate not be, all too negative. So it's probably going to get dark for private real estate here in like the next months or so, 6 months or so, maybe in 2024 is going to be a bad year. And then public REITs are probably going to strongly outperform private real estate because they've already priced that in. They're like, we knew that was coming, a year ago. Now we're pricing in the next year. We're pricing in 2025. What's going to happen there? So that's kind of what I'm looking at with Kilroy and these other REITs. But with that being said, thank you guys so much for watching. If you guys enjoyed this video, feel free to leave a like, subscribe if this is your first time watching Capital Mindset content and you want more analysis like this. And also feel free to check out the link in the description below to see and check everything out, see if you like that. If not, just watch videos here on YouTube. All right, with that being said, see you guys on the next one. Bye.